Coming to more recent, basically what has happened in the last 4 or 5 years, if you look at private sector borrowing, it used to be about 400 billion per year. It went to almost nothing, and now it's still less than 100 billion. This fiscal year just passed, the total private sector borrowing was about 70 to 80 billion. Okay, this is the same private sector which used to borrow 400 billion or so every year. If we look at government, they used to borrow about 100 billion, and now they are borrowing about 5 to 600 billion a year. So government is sucking away all the money from, all the liquidity from the system. Now, if you look at two sectors, government versus private, we know which is more efficient, we know which is less corrupt. So now, instead of this money going to the private sector, which is the engine of growth, which creates more jobs, 9 out of 10 jobs are created by the private sector, which, taxes increase, all those things. A lot of this money is going into to the government, which we know basically is a bucket, which is a hole at the bottom. Okay, so this is, I think, in the in the last 2, 3 years, 4 years, unfortunately, this is a very negative development that we are seeing, that the government spending is crowding out the private sector. And because of this, the rates have gone up, and it's becoming very difficult for the private sector to borrow at these rates and grow. Now, if you look at the stock exchange, because obviously my topic here is linking capital markets or investments to the economy. If we look initially, as the net domestic assets increased, and this growth was directly linked to the private sector credit, the stock market did quite well. And if you just relate this to the previous chart, as soon as the private sector spending declined and the government spending picked up, so the money supply was still strong, the NDA was still strong, because what had happened is that instead of the private sector, now the government took the lead in terms of borrowing. What happened to the stock market? The stock market did not like it, and we saw a major correction in the stock market. If you look at the correlation, the R square between stock market and NDA is 10%, which means 10% of variation in the stock market is explained by basically this one factor, which is the net domestic assets. Okay, but this relationship is not very meaningful, because there are two periods. One period where there was a strong relationship because of the private sector growing, and one period where there was a negative relationship because of the government growing rather than the private sector growing. If you look at the relationship between the stock market and net foreign assets, we see a correlation coefficient of 70%. Which means 70% of performance of the stock market is determined or is related to basically one factor, which is the net foreign assets. Now, when we saw these net foreign assets going down in 2008, because if you remember, the oil prices went up, and were running huge current account deficits, and a lot of people were sending their money outside Pakistan, we saw the stock market crash as well. As long as this NFA was positive, we saw the stock market doing very well. So the correlation of 70%, one only factor, explains 70% of the performance of the stock market, which is the NFA. If you relate it to money supply, the correlation is not significant. Why? Because money supply has two components, the NDA and the NFA. We saw a very strong relationship in terms of NFA, but a weak relationship in terms of NDA, especially after the government started borrowing. So you see that difference here. Again, if you look at the stock market linkage with foreign exchange reserves, the correlation coefficient is 33%, means 33% of variation in the stock market is explained by foreign exchange reserves. As the foreign exchange reserves go up, the confidence improves and people start investing in the stock market. As the foreign exchange reserves start coming down, people start getting out of the stock market. If we look at inflation in the stock market, the correlation coefficient is 23%, means 23% of the stock market variation is explained by inflation. And again, when we saw inflation going up, we saw stock market going down. So there's a strong negative relationship. Now, up to 10%, the market does not care about inflation. But once inflation starts going above 10%, the stock market starts, behaving negatively. If you look at the stock market versus 6 months SHIBOR rate, the correlation coefficient is very strong, 37%. Again, it's saying that 37% of variation in the stock market is explained by the SHIBOR rate. As the interest rates go up, the stock market go down. There's an inverse relationship. And that's what we see here as well. As interest rates went up 10%, we saw the stock market crashing. Same thing when we see the association with 10-year PIBs, the same 31% correlation coefficient, a very strong negative relationship. As the yields went up, the stock market went down. We look at the correlation of the stock market with large-scale manufacturing index. The correlation coefficient is 30%, very strong. As the manufacturing index does well, the stock market does well. As it starts doing well, the stock market starts doing poorly as well. Again, if you look at 6 months SCIBOR now versus foreign exchange reserves, we see a very strong negative relationship. Now here the relationship goes from foreign exchange to interest rates. If you remember 2003, when a lot of money came in after September 11, if you remember, the interest rates had gone down to 3%, 4%. Okay, that was because a lot of money came from outside. The reverse of that happened in 2008. As foreign exchange reserves went down, a lot of money went out. As a result, the interest rates went up. Okay, so again, in Pakistan's context, I think basically we have seen foreign exchange reserves. I think a lot of confidence comes because of these reserves. As these reserves start going down, I think the investment environment starts deteriorating. Okay, we see a linkage with inflation and interest rates as well in terms of the stock market, and we also see a linkage with money supply, as well. If you look at the performance of various investment classes, let me see my time, I think I'm okay on that. The magic of compounding, the longer you leave your investment, the better it grows. If you invest 100,000 at 15% for 10 years, it's 404,000. But if you wait only another 5 years, it doubles. So this is the magic of compounding, investing and staying there for the longer term. Similarly, the difference between 15% and 20% becomes quite large over a longer period. On a 15-year period, investing at 15% means you have about 813,000, and investing at 20% means you have twice that much, about 1.5 million. So the magic of compounding works very well if you are earning a slightly higher return or earning it for a longer time period. If you look at the performance of the Pakistani stock market the last 30 years, the average return has been about 30%. Obviously, you saw this huge dip in 2008. The stock market went down like 56%, has recovered some of it. But if you look at over the long term, the last 10 years, it's about 30%. If you look at a longer period, last 31 years, the stock market returns 17.7, defense savings certificates about 14%, bank deposits about 7.6, inflation about 8%. Now, the difference because of the power of compounding, if you had invested 1 rupee 31 years ago in the stock market, that would be 156 rupees today. The same invested in defense savings certificates would be 57 rupees, and in a bank would be 10 rupees. So the difference between bank deposits and stock market, 10 rupees versus 156 rupees. Over the long term, obviously the stock market does quite well, but obviously shorter term, it is volatile, no question about that. Again, in terms of valuations, one of the basic models that explains stock market valuations is that the price of any company, any investment is determined by the cash flows, in year 1, in year 2, in year 3, and so on. And if you discount it back, considering time value of money, that gives you the value of the company.